So joining us to talk about the electric vehicles market and the slowdown that we're witnessing in the EV market sales in the last year or so is Anna-Marie Baisden, the head of the Autos and Infrastructure Research at Fitch Solutions. Anna-Marie, thanks for taking the time and joining us. How would you describe the slowdown in the EV sales quantitatively and qualitatively over the different regions globally, and are there varying reasons behind this deceleration?
Yes, it's important to say that we are talking about a slowdown in sales growth. So at this point, we're not necessarily talking about EV sales declining, but because for much of the world we're still in a very early stage, then it has been, I think, disappointing in terms of the adoption that people were and companies were expecting. So we're forecasting EV sales growth of 20% this year, which, you know, for the regular autos market would be fantastic. But when you put this into the context of a very nascent EV market and the fact that there was growth of 60% 2 years ago for global EV sales, some individual markets having more than 100% growth, then suddenly we can see that there has been a real slowdown over this year. And as you said, there are some regional differences. So if you were to look at China, for example, world's biggest EV market, in this case, you'd almost expect to see some diminishing returns because of the size of the market, the fact that it's been so far ahead of other regions. And that's why we've seen the government bringing in more incentives this year to try and kickstart sales growth again. So they're trying to encourage scrapping older vehicles, for example, in exchange for EVs. In Europe, we've struggled more with costs, so the high prices of EVs, the high cost of borrowing when we've been through a very high interest rate period. And that's been similar for North America as well, high costs that have deterred consumers, and also quite low charging infrastructure in comparison with the size of the autos market. So slightly different factors in different regions, and then some global factors as well, such as the supply chain disruptions that we saw, which limited inventories, and some rising costs and some shipping bottlenecks. So there's been a combination of many factors.
Surprisingly, we've seen EV sales in France faring strongly in the first half of this year, contrary to the wider Western European slowdown that you've just mentioned, and despite the reduction of French government EV subsidies. So how come? And is this French-centric, or could this happen in other markets, you think?
Yes, France is an interesting one. But what we've noted is that the change to the incentive scheme actually cut out higher income earners in terms of the incentives. So those people who perhaps didn't need to rely on the incentives in the first place to afford a vehicle, but the incentives are still available to those lower income consumers who probably need to rely on them a bit more. So at the moment, we would say this is very specific to France and the way that their incentive scheme is structured. But, you know, if other countries were to follow this model, because this has been an argument in a number of countries that incentives are going to people who don't necessarily need them. So perhaps if other markets followed suit, we could see the same results.
How is the slowdown in the EV sales being translated into investments into the EV supply chain? And maybe if you can break down for us these numbers in terms of investment value and in terms of the number of projects as well that we've seen in the last few quarters or the first half of this year.
We are certainly seeing this slowdown playing out in investment as well. We regularly monitor investment into the manufacturing side of the industry by region and on a quarterly basis, so we're able to make comparisons. And what we've seen in the first half of 2024 is that globally we've seen the number of projects related to EVs and the EV supply chain falling from over 140 to just over 100. And the value in particular has fallen from over 130 billion globally in the first half of 2023 to just around 50 billion in the first half of this year. And also in some cases, projects that had already started, work had already started on them, they're either being suspended or cancelled altogether. So we've seen that in Western Europe and in North America.
Volvo just did a U-turn on its commitment to go full electric by 2030, just 3 years after making that announcement. It joins others like GM, who has a couple of months ago cut its EV production forecast as well. This is in addition to a number of other auto producers who have recently scaled down or postponed their upcoming EV offerings. Do you reckon this EV slowdown is a temporary market condition, or is it misplaced optimism on consumer demand for EVs?
Certainly, we expect slower growth again in 2025. So currently we're forecasting just a 5% increase in EV sales next year. There's a lot of uncertainty facing the EV segment in key markets. I mean, the US election is just one risk to the EV market in that country. So in some respects, we see it's temporary, because in a couple of years or so, if the market can normalize, so if we can start to see prices starting to come back down, if we see less trade disruption because we see this nearshoring and onshoring starting to pay off in terms of localized supply chains, then we'd expect to see sales picking up again. But I think it's also the case that there has perhaps been a little bit of overestimation of how much consumers are willing to make that switch. We know from some surveys that there are people who are still reluctant, whether it be because of price or range anxiety or just because they don't want to make the switch. So we're already seeing the EU looking at whether phasing out internal combustion engine vehicles by 2035 is still viable. So I think we might see a few markets starting to consider whether a regulation-driven market can achieve these goals on its own, or if they have to start taking consumer preference into account more.
In this case, would you be surprised if more automakers follow Volvo in the coming months?
It would not be a surprise, actually, because we're seeing more examples of that. We've seen a number of companies, whether they're European or American, starting to change their strategies, starting to allocate investment towards more hybrid models. Hybrid sales have actually been very strong, while we've seen a tail off in full electric models, because they're a little bit cheaper. You don't have as much range anxiety. So for those companies that have hybrid models, they've been able to make a switch. We've even seen Mercedes coming out recently and saying that they're allocating some of their R&D spend from EVs back to internal combustion engine vehicles. So yeah, we would not be surprised to see maybe not such dramatic changes as Volvo, but certainly changes in strategy.
Let's talk about the big antagonism between the West and China when it comes to EVs. On May 14, US President Joe Biden announced that the United States would slap a 100% tariff on imports of Chinese-made EVs. The EU proceeded to place tariffs as well on China's EV imports. That came into effect on July 4th, ranging from 17.5% to 37.5% approximately, in addition to an already existing 10% duty for all of EVs imported from China. And just last month, Canada said it will impose a 100% tariff on imports of China-made EVs. Will these measures be enough to nurture Western EV makers despite the current market headwinds and the slowdown that we're discussing?
It's unlikely that tariffs on their own will be able to improve the competitiveness of Western car makers. Firstly, because a lot of the Chinese models that are on sale in Europe, for example, the price advantage was already so much that a lot of them will still be more affordable than Western models, even with the tariffs. And secondly, it's only really deterring the competition rather than supporting the competitiveness of the domestic producers. So really what's needed is more supportive policies for the local producers, as well as just trying to deter the competition. So something like the Inflation Reduction Act in the US, it's been very positive in terms of encouraging investment in local production. So we didn't really see an equivalent in the EU in response to that, but there definitely needs to be something to help the local manufacturers, as well as just deterring the Chinese competition.
Anna Marie, most media debate centers on the Western pushback against cheap Chinese EV imports, notably the US and Europe. But could the rise of low-cost Chinese exports also pose a key policy challenge for emerging markets, and how so?
Absolutely. Trade data from 2023 actually shows that the majority of Chinese EV exports went to emerging markets. And if you think that, yes, there's been a lot of coverage of the big developed markets that have big auto industries and want protection, there are also emerging markets where the auto sector has been a big part of their economic development. And so it's just as important to protect the industry in those markets, such as India, Mexico, Brazil. So policymakers there are also going to be facing this issue.
What are some notable examples of recent EM protectionist policies against Chinese-made EVs? You've mentioned Brazil and India.
Yeah, so in some cases, we've seen a similar response to the developed markets. So in Turkey and Brazil, they've imposed tariffs as well. But they've also coupled that with incentives to attract local production, and that's been quite successful because we've seen BYD, the biggest Chinese EV manufacturer, announce investments in both of those countries. India's also implemented tariffs, but it's done it in a way where it covers Chinese brands but not other foreign manufacturers, for example, such as American brands. So they've approached it in different ways.
But emerging markets in general are still heavily dependent on internal combustion engines. So couldn't it be argued that Chinese focus on EVs specifically might not significantly impact internal combustion engine makers and markets in emerging countries?
In the short term, that's likely to be the case. There are a lot of emerging markets where, for one reason or another, whether it be affordability or they don't have the charging infrastructure, that the EV market is very small or non-existent. And so in that respect, at the moment, these Chinese brands are not really a threat. But given our forecasts, even even in the current downturn in terms of EV sales growth that we're seeing in years to come, we expect to see EV adoption taking off in a lot more of these markets, and then it will become more of an issue for other emerging markets that have a domestic manufacturing base, and also for the fact that they don't want these domestic producers to be missing out in terms of exporting to developed markets or other emerging markets that have more of an EV market.
But how could emerging market policymakers walk this tightrope with China over EVs, especially that most emerging countries have strong political and/or economic ties with China?
It's true. It's a real balancing act for a number of markets. And what we've noticed is that there are some regional differences. So we see some markets, particularly in Southeast Asia, that have a big auto sector, but they're also quite economically close to China. So Thailand, Malaysia, Indonesia, we see them being quite exposed to this issue. But then there are other emerging markets in emerging Europe, in Latin America, where they're more aligned with the US and other Western markets. And so we actually look to the tech sector for examples of what's happening there. And it's likely that we could see a division, as we have in the tech industry, where there are those markets that are happy to have the Chinese manufacturers and to align with them, and then other markets that will stick with the Western brands that they already have.